Welcome to the Radio Revenue Podcast.
Glad to be back for another deep dive.
Yeah, it's great to have you. It is late February 2026, and today we are looking at a document that is, well, it's essentially a map of the global economy, just kind of disguised as a financial report.
That is a very accurate way to put it.
Right. We are tearing into the 2025 annual report, the Form 10K for ConocoPhillips. And for you listening at home, this isn't just your standard corporate update.
No, absolutely not. I mean, map is exactly the right word here. When you look at this document, you see a company sitting on a staggering $122 billion in total assets.
Which is just a massive number to even wrap your head around.
It really is. And they have a workforce of nearly 10,000 people. 9,900 to be exact. Their operations stretch everywhere, from the frozen tundra of Alaska all the way to the deserts of Libya. It is just an absolute beast of an operation.
It is a beast. But reading through this, I didn't just get a sense of size. I got a sense of tension. Well, 2025 felt like a year where ConocoPhillips was trying to do two totally opposite things at once. On one hand, they're digesting this massive acquisition of Marathon oil, right? Getting bigger, heavier, more complex.
Right.
But on the other hand, they're trying to stay agile. They're trying to navigate this regulatory landscape, especially here in the U.S., that is incredibly volatile.
You hit the nail right on the head. That is the central conflict of this entire 10K.
Yeah.
The theme of their 2025 wasn't just, pumping more oil. It was massive integration and strategic positioning.
Yeah, figuring out how to be a giant in a world that basically demands you move like a ninja.
Exactly. I mean, they closed the Marathon deal late in 2024, sure, but 2025 was the year they actually had to make that marriage work. They had to fully integrate those assets in the first half of the year.
And that's exactly what I want to unpack for our listeners today. How does a company this huge, and I say this lovingly, but how does an oil major dinosaur learn to dance?
It takes a very specific philosophy.
Right, especially when they rely on this strategy that just kept popping up everywhere in the reading. They call themselves unhedged.
That is the absolute magic word for their entire approach. Unhedged.
Honestly, it sounds terrifying to me. It sounds like what a riverboat gambler does. But let's start with the big numbers first, just to see if that gamble is actually paying off.
Let's do it.
So, looking at the 10K, what's the one headline figure that defines 2025 for them?
It definitely has to be the production number.
Yeah.
Your total production for 2025 came in at 2,375 MBOED.
Okay, let's decode that for the listener. MBOED, that stands for 1,000 barrels of oil equivalent per day, correct?
Correct. So you're essentially looking at 2.37 million barrels of oil, or the natural gas equivalent of that, every single day.
That is just a staggering amount of energy moving through the system daily. How does that compare to where they were before they brought Marathon into the fold?
It is a massive 20% jump from 2024. Yet for a company of this maturity, you usually fight tooth and nail for maybe 2 or 3% organic growth. So a 20% increase is a complete step change. And obviously, the primary driver for that was the Marathon oil acquisition.
Right, they basically just bought the production.
You did. But as you know, buying production is the easy part. You just write a very large check.
Right.
The hard part is integrating it without the whole machine grinding to a halt. And the report talks heavily about synergies.
Yeah, let's talk about synergies. I usually roll my eyes when I see that word in corporate documents because it usually just sounds like a polite way of saying, we fired a bunch of redundant managers.
Well, let's be fair. In M&A, it often is exactly that. But in this specific 10K, they actually put a hard price tag on exactly what those synergies are worth. They achieved more than $1 billion in synergies on a run rate basis by year-end 2025.
Break that down for me. What does run rate basis actually mean in this context?
It basically means that going forward, every single year, their operating costs are $1 billion lower than they would have been if ConocoPhillips and Marathon had just stayed separate companies.
That's incredible.
It is. It comes from supply chain savings, combining back office functions, optimizing their logistics, getting better deals on sand and steel, all of that.
So that's essentially $1 billion a year in found money.
Exactly. And on top of that run rate, they highlight another $1 billion in one-time benefits in 2025.
One-time benefits? Like what?
Mostly tax-related structures, effectively using net operating losses, things like that. So they really squeeze the value out of the deal almost immediately.
Okay, so that's $2 billion of value just from tidying up the books and merging the offices. But let's go back to that scary word I mentioned earlier, unhedged.
Yes, the unhedged strategy.
The report says they remain deeply committed to being unhedged. If you're a listener who doesn't actively trade commodities, why does that matter? Why is that a deliberate strategic choice rather than just, I don't know, a lack of planning?
Think of it like a farmer. Most farmers, before they even plant their seeds, will sell their crop to a buyer at a fixed price.
Right, to guarantee a return.
Exactly. That is hedging. It guarantees they won't go broke if the price of corn completely crashes by harvest time. But it also means if the price of corn suddenly triples, they don't make any extra money. They traded their upside for safety.
And ConocoPhillips is the farmer who just flat out refuses to sign that safety contract.
Precisely. They do not use financial derivatives to lock in prices. They take the market price, whatever it is, every single day. They ride the market waves.
That just seems incredibly risky for a company with $122 billion in assets. You're telling me their revenue is entirely at the mercy of the market. If oil drops to $40 a barrel, they just take the hit.
They take the hit. But they would argue it is not risky because they pair it with a very strict discipline. To survive being unhedged, you must have what they call a low cost of supply portfolio.
Okay, meaning it just costs them less to get it out of the ground?
Right. If it costs you $30 to pull a barrel of oil out of the ground, and the global price drops to $40, you are still making a profit. You don't need to hedge to survive. And when the price spikes to $90?
You keep every single penny of that upside.
Exactly. Because you didn't sell it cheap on a futures contract a year ago.
So the hedge isn't a piece of paper with a bank. The hedge is their own internal operational efficiency.
That's a great way to put it. Their efficiency is the safety net.
Which perfectly explains the other side of the coin I saw in part 1 of this report. Capital discipline. If efficiency is your safety net, you cannot afford to hold on to expensive junk assets. And they were selling off assets pretty aggressively in 2025.
They were really cleaning house. They set a disposition target to sell $5 billion in assets by the end of 2026. And in 2025 alone, they already closed $3.2 billion.
Yeah, I saw they sold off the Ursa and Europa fields.
Right. Those are older, deep-water assets in the Gulf of Mexico. And they also sold some assets in the Anadarko Basin.
It feels a lot like pruning a tree. You cut off the dead or heavy branches so the main trunk gets stronger.
Or, to use another analogy, it's like selling your old gas-guzzling truck so you can put all your money into your fleet of high-performance race cars. They're moving capital away from mature assets and funneling it straight into what they call the lower 48.
So let's shift to part 2 of our deep dive and talk about that fleet of race cars, the lower 48. The report basically identifies the onshore U.S. segment as the absolute heavyweight champion of their portfolio.
It is the engine room. The lower 48 contributed 67% of their consolidated liquids production and a massive 74% of their natural gas.
Wow.
Yeah, if the lower 48 sneezes, the whole company catches a cold.
And inside that engine room, they focus on the big 3 basins: the Delaware, the Eagle Ford, and the Bakken. The scale they have in the Delaware Basin specifically is just hard to wrap your head around. They're sitting on 782,000 net acres there.
It is massive. And just look at the activity level they reported. In 2025, they were running 10 drilling rigs simultaneously in the Delaware. They brought 161 operated wells online.
That's not even exploration anymore. That is factory-level throughput.
Exactly. It's an assembly line.
And they did even more in the Eagle Ford, 264 operated wells brought online.
The Eagle Ford is a bit more mature for them, so they're doing what they call full field development. They are highly customizing their well spacing to get every last drop out of the rock.
And then there's the Bakken up north in North Dakota and Montana with another 98 wells brought online. But here is my big question about this. Why focus so heavily here? Why are these 3 basins the race cars compared to, say, a massive offshore drilling rig?
It all comes back to that unhedged strategy we just talked about. These unconventional shale plays have a very short cycle time.
Short cycle time. Unpack that for the listener.
It implies speed and flexibility. If you decide to drill a well in the Eagle Ford today, you can literally have oil flowing and generating cash in a few months. That's a short cycle. If oil prices crash next week, ConocoPhillips can just tell the rig crews to stand down. They can ramp up or ramp down relatively quickly.
Right, whereas with a massive offshore project,
Deepwater is a marriage.
Yeah.
You commit billions of dollars today, and you might not see your first drop of oil for 7 to 10 years. You can't just pause the construction halfway through because the price of oil dipped. You are locked in. The lower 48 gives them incredible optionality.
Okay, so the lower 48 is the speedboat. You can turn it quickly to react to the market. But you can't run a $122 billion company just on speedboats. You need an aircraft carrier, too. And that brings us to part 3, Alaska.
Alaska is definitely the long game. This is where the strategy totally shifts from months to decades.
The Willow project. Now, anyone following energy has been hearing about Willow for years, mostly in the context of intense political debates, lawsuits, and protests. But reading the 2025 report, it sounds like all of that is in the rearview mirror, and the bulldozers are just running full tilt.
They absolutely are. 2025 was officially designated as their peak construction season for Willow. They are out there moving serious dirt in the western North Slope.
What exactly are they building right now?
Gravel roads, massive pipeline construction, hooking up the Central Operations Center. The report notes they expected to reach nearly 50% completion by the 2025 winter season.
But despite all that activity, there's still no oil coming out, right? They're spending billions, but the cash register isn't ringing.
Not a single drop yet. First oil isn't anticipated until early 2029.
So this is the exact opposite of the Eagle Ford. They are pouring a fortune into the frozen ground today, fully banking on it paying off in the 2030s.
That is the beautiful balance of a diversified portfolio. The massive cash flow from the Eagle Ford and the Delaware, that's the now money. And they're using that to fund Willow, which is the future money.
Because the shale wells don't last forever.
Exactly. Shale wells has steep decline rates. You drill them, they gush for a bit, and a few years later, they're just trickling. You need a massive, stable, conventional producer like Willow to anchor the company's production for the next decade.
And speaking of anchors, they still have the old guard in Alaska operating too, Prudhoe Bay.
The largest conventional oil field in North America. Still going strong.
It's amazing it's still producing. I feel like people have been talking about Prudhoe Bay declining since the 1980s.
It's a testament to their engineering. Both there and at the Cuparuque field, they are heavily using enhanced oil recovery, specifically waterflood techniques.
Injecting water to push the remaining oil toward the producing wells.
Right. They're essentially squeezing that geological sponge completely dry.
So we have the fast U.S. shale machine and the massive Alaskan fortress. But this is a global report, which takes us to part 4, international operations. And honestly, this section is where I saw some of the most fascinating technological and political details. Let's hop the border up to Canada first.
Canada is really interesting from a geological standpoint. Look at their Surmont asset. It is an oil sands project.
Which means the oil isn't sitting in a liquid pool. It's basically mixed with sand and clay, right?
That's it. It's bitumen. It has the consistency of cold molasses. You cannot just stick a pipe in and pump it. So they use a technology called SAGE-ED that stands for Steam-Assisted Gravity Drainage.
How does that work in practice?
It's brilliant. You drill 2 parallel horizontal wells. You inject high-pressure steam into the top one, which heats up the rock and melts the bitumen. Then gravity pulls that melted oil down into the bottom well, where you can finally pump it to the surface.
That's wild. And the report highlights a major milestone for that asset in 2025.
They achieved first production from Pad 104 WA in the 4th quarter. It proves they can successfully keep expanding that heavy oil resource.
And they also have the Montney play in Canada, which looks a lot more like the U.S. fracking operations.
Right. Montney is a liquids-rich, unconventional play. They drilled 31 wells there in 2025. Canada remains a very reliable, steady contributor for them.
Now let's go across the Atlantic to Europe, specifically Norway. They operate the Greater Ekofisk area in the North Sea. But what stood out to me wasn't the drilling technology, it was the tax bill.
The carbon costs.
Yes. The 10K explicitly notes that compliance with Norwegian carbon legislation cost ConocoPhillips approximately $42 million in 2025.
Which is a very real glimpse into the future of global energy economics. In Norway, emitting carbon dioxide isn't just an abstract environmental issue. It is a very tangible line item on your expense report.
$42 million is real money. It becomes an operating cost, just like buying steel casing or paying your rig crews.
It does. And it forces incredible efficiency. If polluting costs cold, hard cash, you figure out how to stop polluting. It directly aligns the financial incentives with the environmental goals. They have to run a much tighter ship in Norway than almost anywhere else in the world.
Moving over to the Asia-Pacific region, I noticed a very heavy pivot toward LNG, liquefied natural gas.
LNG is basically the critical transition fuel for the massive Asian economies. ConocoPhillips is part of the Australia-Pacific LNG joint venture, or APLNG.
Right, supplying gas from the Bowen and Surat basins to huge customers like Sinopec and Kansai Electric.
Exactly. But their real power move in 2025 in that region was in Malaysia.
The Kebabangan Cluster, or KBBC.
Yes. In January 2025, they underwent a major strategic shift there. ConocoPhillips actually took over as the sole operator of KBBC. And they didn't just take over. They extended the production sharing contract all the way out to the year 2050.
2050. That specific date just keeps coming up in this report. They also signed an agreement in Libya extending their Waha concession until 2050.
You really have to pause and think about that. 2050 is a quarter century away. They are signing legally binding contracts that will expire when a baby born today is entering the workforce.
It shows a tremendous amount of internal conviction that the global economy is still going to desperately need these hydrocarbons for a very long time.
Or at least that specific regions like Malaysia and Libya will.
It highlights the massive disconnect we often see in public discourse. You read constant headlines about the immediate end of oil. But out in the real world, these energy companies are putting ink on paper for multi-billion-dollar commitments that run well into the mid-century.
And they're doing the exact same thing in China. The Penglai fields saw Phase 4B and Phase 5, bringing dozens of new wells online in 2025.
And don't forget the Middle East. They are heavily participating in Qatar's massive North Field East and South LNG expansion projects. They are planting huge operational flags for the long haul all over the globe. Well, speaking of headlines and the future of energy, we have to talk about the government. Part 5 of our deep dive covers policy, taxes, and risks. And there is one specific piece of legislation named in this report that, I'm not going to lie, I honestly thought was a typo the first time I read it.
You're referring to the One Big Beautiful Bill Act.
The OBBA, enacted on July 4, 2025. I mean, one big beautiful bill. Who comes up with these names?
Apparently the U.S. Congress does.
Right. So, setting aside the incredibly creative naming conventions, what did this beautiful bill actually do for ConocoPhillips?
Well, it certainly helped their bank account. The 10K notes that while the act didn't drastically change their overarching effective tax rate on paper, the specific way the provisions worked out resulted in a cash tax benefit of approximately $0.4 billion for them in 2025.
So basically a $400 million cash gift from Uncle Sam right on Independence Day.
Essentially, yes. But you shouldn't let that $400 million fool you into thinking the government made life completely easy for them in 2025. There is a whole section in the risk factors portion of the report regarding the EPA that is quite alarming if you are a business trying to plan for the future.
Yeah, the report describes a sort of regulatory whiplash.
That is the perfect term for it. Look at the timeline they lay out. Back in 2023, the EPA finalized these very strict methane rules, so the entire industry spends millions gearing up to comply with them.
Right.
Then, in 2025, the political winds in Washington completely shift. The EPA suddenly moves to dismantle some of those exact same climate regulations and delay all the compliance deadlines.
No, wait, let me play devil's advocate here. Isn't that a good thing for an oil company? If I'm ConocoPhillips, don't I want the EPA to back off and loosen the rules?
You would intuitively think so. But the report goes out of its way to highlight that the resulting uncertainty is actually toxic to their business model. They specifically cite the danger of policy swings.
Okay, because of the long timelines we talked about earlier.
Exactly. If you are designing the Willow project in Alaska, and it needs to run safely until 2050, you desperately need to know what the rules are. If the regulations are strict, you engineer a strict facility. If they are loose, you engineer a loose one.
But if the rule book literally flip-flops every 4 years depending on who is sitting in the White House, how do you possibly design a multi-billion-dollar piece of infrastructure?
You are paralyzed.
Yeah.
Because if you build the cheaper, less regulated version today, and then the rules inevitably tighten again in 2029, you have to go back and retrofit everything while it's running, which costs an absolute fortune.
So to be clear for the listener, we aren't taking a political side here on whether the rules should be strict or loose. We are just looking at what the company is saying in their SEC filings. And they are saying that business absolutely hates chaos.
Exactly. Even if the chaos technically results in deregulation, the sheer lack of predictability makes capital allocation a complete nightmare. Large corporations crave a steady rulebook, even if it happens to be a tough one.
And what's fascinating is that despite the EPA loosening those rules in 2025, ConocoPhillips seems to be voluntarily ignoring the relaxation. Look at their ESG performance section. They specifically highlight their flaring targets.
They do. They reported that they officially met their target of zero routine flaring by the end of 2025 for all their heritage ConocoPhillips assets.
And they didn't stop there.
No, they immediately set a new, tighter goal. Starting in 2026, they want a flaring intensity of less than 0.75% of the gas they produce.
So the federal government is basically saying, hey, you guys can relax the methane standards a bit, and ConocoPhillips is internally saying, no thanks, we're actually going to tighten them.
Because it goes right back to that operational efficiency we talked about.
Yeah.
Flaring natural gas into the atmosphere is literally just burning potential revenue. If you can capture that gas instead and put it in a pipeline to sell, you improve your margins.
It perfectly aligns with their low cost of supply mantra.
And furthermore, they are smart enough to know that the federal rules might easily tighten right back up in 2029. Staying ahead of the regulatory curve voluntarily is the ultimate hedge against political whiplash.
So let's try to pull this all together. We've looked at the big financial numbers, the specific fields, and the federal regulations. 2025 was a year where ConocoPhillips got significantly bigger by swallowing Marathon. They are drilling like crazy in the short cycle lower 48 to generate cash right now. They are building the massive Willow project to generate cash a decade from now.
And they are doing all of this while the regulatory environment plays ping pong.
Exactly. And the craziest part is they are doing it all without a traditional financial safety net. They are remaining completely unhedged.
It really feels like a high wire act, doesn't it?
It does. It feels dangerous.
It is dangerous. But they clearly believe they are the best tightrope walkers in the entire industry. The Marathon acquisition proves they believe that massive scale is the ultimate answer. Being the biggest, most ruthlessly efficient operator on the board allows you to simply absorb the market shocks that would completely wipe out a smaller company.
You know, it also strikes me that while they refuse to hedge financially, they are absolutely hedging on geography.
That's an interesting point.
Yeah, think about it. If the U.S. regulatory environment gets too chaotic with bills like the OBBA and the EPA swings, well, they have Norway.
Right.
And if Norway gets too expensive with their steep carbon taxes, well, they have long-term LNG contracts in Qatar and Malaysia out to 2050.
That is the hidden hedge, global diversification. By balancing short-cycle U.S. shale with long-cycle international gas, and by spreading their footprint across a dozen different political regimes, they are trying to ensure that no single local disaster or policy swing can sink the global ship.
So here is the final provocative thought I want to leave you, the listener, with today. We live in a world where voters and politicians change the rules every 2 to 4 years. But genuine energy security requires infrastructure investments that must last 20 or 30 years.
That specific timeline disconnect is the fundamental risk of the modern energy market.
Exactly. So is ConocoPhillips' unhedged strategy an act of financial bravery, or is it simply the only logical option left on the table? When you can't trust the regulators to stay consistent and you can't predict the geopolitical shifts in places like Libya or China, maybe the only thing you can truly control is your own internal efficiency.
You just drive the car as carefully and efficiently as you possibly can because you know for a fact the road ahead is going to be full of massive potholes.
That is the multi-billion-dollar bet they're making, is a low cost of supply enough to weather literally any storm the market throws at them. Their 2025 report confidently says yes, but the storm certainly isn't over.
It never is in the energy markets. The volatility is the only constant. And we will definitely be here to track how that bet plays out when the 2026 numbers finally drop.
Absolutely looking forward to it. It was a Revenue Radio podcast. Thank you for watching. Please like, subscribe, and hit the bell to stay updated with our latest analyses.